take away from what I've heard this morning is that there are as many challenges ahead of us as there have been over the last few years. In particular, I thought Gavyn's point about the ECB was managing money in the context of feeling the inevitability of something needing to be done at some point, but not knowing when it would happen, and that in the preceding months prior to them doing something, you could be facing quite a few risks and headwinds. I think the point about bond yields potentially being under pressure to remain really quite low for quite a long period of time doesn't really open up any obvious solutions in that front. So a balance between appropriate return-seeking asset allocations, appropriate risk management and risk targeting, and a balance between these to try and create something that's robust and reliable seems to be a theme that we're going to continue to push throughout this year. Another point that's come out of the last year, a very common theme, is this issue of what is your bet you're actually taking when you're saying that you think rates will rise. And this concept of the forward rate, we didn't really talk about it much during the presentations today, but it's very relevant when you've got the situation where short rates are likely to stay quite low for quite long, the yield curve is quite steep, that you're actually betting on rates rising above the forward rates, not rates just rising.
Just from a liability perspective, is it more a real rate story, or is it going to be more of an asset impact story? As this exit comes through.
Yes, certainly. I mean, it's. I think taking our sort of collective views together, I think that the implications seem to be that it's still a constructive environment for growth assets in general and longer term inflation assets, because we know that's what central banks want. But the bare leg in conventional government bond yields has been postponed because of too much skin in the game, and because governments can't yet, with big debt numbers, allow bond yields to rise aggressively. So it reminds me very much of 2009, when economies were still dodgy, but the taps were turned on, and generally growth assets did rather well. Equities bounced in spring, as did commodities, as did property. But as soon as central banks became complacent, these things turned south again. I don't think complacency this time is going to creep in, because central banks need to make darn sure there's growth and inflation, because as I said, the alternative deflation is just unthinkable. But going back to Darwin's point, if there's one thing that's clear, is central banks crave inflation.
Bonds are now yielding 280, not 130. So they are beginning to come back to a more normal position in terms of their value as a diversifier in portfolios. Obviously, when they're yielding 130, it's highly unlikely they're going to do much you're going to get much diversification benefit from them in a recession, because they've got nowhere to go much, like in Japan. Now at 280 or thereabouts, you could see a pretty significant bond rally if we are wrong and we hit another recession. So they are more useful than they have been, I think, as diversifiers for your portfolio. They're giving you higher yield, obviously, but also they could rally sharply in a recessionary environment. So that's the second thing. The third thing that this says to me is, what is the chance of really being wrong on bonds because they go to 5% yields? And I think there's a lot of people who think that may happen, especially in the US.
The UK obviously has probably started to see maybe the most surprising pickup in terms of the economic surprises. At the same time, we've obviously seen inflation fall finally below the BOE's formal inflation target, but we haven't seen any impact whatsoever on long-dated break-evens really at all yet. Do you have a feel for, when that might start to feed through, or how long you'd expect to wait to see impacts of that lower spot inflation coming through on the long end of the market?
Yes, well, two things. Firstly, not just in the UK now, but globally, it seems to be an era of falling headline inflation rates, including even in the UK. Was it last week when we saw CPI hit 2%? And after pretty much 5.5 years of overshooting target, the world now seems to think that we're never going to go back up to 2%. thereafter. But it seems to me that one reason why break-evens have been calmed as well has been the market's own interpretation of Carney's gift to us, which is forward guidance. Because when you go to the private meetings after the quarterly inflation report press conferences, the bank is quick to stress what they don't want is for markets to believe that there's something sacred about a 7% unemployment target. And I get slightly frustrated with my fellow peers who burn the midnight oil trying to figure out to the day when 7% unemployment is going to arrive, at a time when real wages are, have been squeezed the most since the early 20s. So my point really is that all these things together are keeping break-evens, especially at the front end right now, under control, not just in the UK, but for the main markets.